Hi everyone, Simon Barwick here from Bentleys Wealth Victoria, here to present our 2026 budget update. Once again, this is general information, so if you do have a specific question, please speak to your advisor. I'm going to cover some broad financial planning focused areas today, but if you do want to look at anything relating to your businesses, please refer to the Bentleys business update, which we also forwarded in this presentation. I'm going to focus today on four main areas, being superannuation, tax, social security, and then some broad other areas. It's important to note that these are proposals only and need to go through both houses of parliament in Australia. So there may be some further changes to come, and we'll keep you posted on these. If we look at the tax changes, these are really the continuation of the existing stage 3 tax announcement. So no further changes to these. So this really provided tax relief for most Australians, and specifically a broadening of the 30% base. So it really means from a planning perspective that there's an opportunity to increase savings of super contributions, improve your cash flow, and consider tax investments, tax effective investments going forward. One of the big announcements was capital gains tax and some changes to the current regime. So from the 1st of July 2027, they are replacing the current 50% discount with a cost-based indexation. They're also introducing a 30% minimum tax on net capital gains, and this will be calculated from that date, 1st of July 2027. The 50% gain still applies to assets up to that date. And there will be a main residence exemption and a small business concession, which will continue. This, however, won't apply to any social security or low income recipients. What this means from a planning perspective is that it's going to be important to review future asset sales and the timing of these, but we would counsel against any knee-jerk reactions in the short term. The other announcement was relating to negative gearing, which will be implemented from the 1st of July 2027 as well. So negative gearing will be limited to new investment properties only. This will specifically mean that losses on newly acquired properties can only be offset against other property income. So that will create some cash flow issues for some people. Excess losses can be carried forward and new builds will be exempt. So what this means from a planning perspective is that there will be reduced tax benefits for investing in established properties. There'll be a greater incentive towards new properties, and investment decisions will really need to be focused on cash flow and growth. Another announcement was relating to discretionary trusts, where there will be a 30% tax minimum, and this will impact some clients significantly. This was proposed from the 1st of July 2028, and trustees will have a minimum of 30% tax on trust income. Beneficiaries will receive credits on that tax already paid. However, there is a sting in the tail in the sense that if your tax rate is below 30%, you won't receive a refund. This does exclude fixed trusts, super funds, deceased estates, and charities. There will be a 3-year rollover relief available, so this will give clients some time to restructure their current affairs. So what this means from a planning perspective, there is a reduced effectiveness for trusts. There will be potential for some increased liability for family group taxes. So it's really important then to review your current trust structure and an opportunity to do so within the 3-year period, as I mentioned before. Other announcements relate to working Australians tax offset. So there's a proposed $250 annual tax offset from the 1st of July 2027. That will apply to income and sort of sole trader income and apply to singles, families and seniors. So it's a modest, really, improvement in after-tax income for those groups. It's not a big announcement. There will be another, also a $1,000 instant work related deduction that'll be applied from the 26-27 year. So this will allow you to claim up to $1,000 without receipts. Individuals can claim individual expenses still if higher. So just really focus on amounts, on your receipts if it's over that amount. Superannuation, there's been no real changes. There is some indexation that's going to apply from the 1st of July this year. And there'll be continued discussion around the over $3 million balances. So from a planning point of view, super still remains really tax effective and supports long-term planning. So consider your concessional contributions for this financial year and maintain appropriate pension withdrawals. So I'll quickly touch on Social Security. So there's been some cost of living announcements. So there's been energy bill relief extended, rent assistance has been increased, and some ongoing pension indexation. Private health, this has been reduced for over 65 to align with those under 65. Foreign investment, there's been an extension to 2029 for those foreign investors who cannot purchase property. So yeah, that will impact that group. So that's it for me. I hope that was of benefit to you. Once again, if you do have any specific questions, please contact your advisor. We will be in touch shortly with our monthly update on our portfolio and economics. But yeah, please contact us with any questions in the meantime. Chat soon.